In this video, we'll break down how options are priced. There are a few key components that make up this pricing mystery, and we're going to dive into each of them. So let's get started. Okay, so let's go ahead and take a look at how option contracts are priced. Now, there is an actual formula for this, but we're not going to dive into it. We don't need to bring back high school calculus. Let's just talk about the basics of how the options are priced. So this way, when you see an option price, you can quickly gauge where it might be coming from. So first, what we want to do is we want to take note of where the current stock price is sitting in comparison to the strike price. You'll understand why in just a minute, but what I mean by that is if the stock price is at $250 and the strike price of the contract is at $230, that's important. So we want to take note of where the stock price is and where the strike price is. So the first thing that makes up an options pricing is intrinsic value. Intrinsic value is going to be found in contracts that are in the money. So what this looks like is, for example, if a call option strike price is below the current stock price, it's in the money and holds intrinsic value. Now let's break this down into some numbers so that it's easy to see. So let's say that you own a strike at $200 and the stock goes up to $250. Then there is $50 worth of intrinsic value between the strike price and the actual stock price. This strike of 200 is in the money. This is what we're looking for, in the money. The reason we say this is intrinsic value is because if you were to exercise your right to buy these shares at $200 at expiration and the stock price was at $250, then you have $50 of intrinsic value. So you're $50 above the strike price. The stock is $50 above the strike price. And alternatively, if we have a put option strike price that's above the current stock price, it holds intrinsic value. Because for puts, we want the price of the stock to go down, right? So if we have a put contract at $200 and the stock itself goes down to $180, then we've got $20 of intrinsic value between the $200 strike price and the $180 price that the stock itself is sitting at. So let's break it down again so that you can easily walk through this and just see exactly what I'm saying here. So intrinsic value example. So we have a call at 230, right? So the 230 strike, we're sitting here at 230. The stock price itself is at 240. So we're above that, right? So here's the strike and here is the stock itself. The difference between these two is $10. Okay, so that is the difference between these two, and that is what intrinsic value is. So if these contracts were exercised and turned into shares, each share purchased at $230 would have $10 of value with the stock at $240. So if you buy a contract at $230, and let's say at expiration you decide to turn this into shares, then each one of these shares, which are at $230, while the stock itself is at $240, would have $10 each of intrinsic value. So you'd have 100 shares that are worth $10 each. Okay, so now let's say that the premium for that $230 strike was $14. Okay, so we know that $10 of that is intrinsic value, right? We just went over that. But what is the other $4? The other $4 is extrinsic value. Extrinsic value are things like how much time is left until the contract expires and how high the IV is, or implied volatility. There are some other small factors that make up extrinsic value, but these two are the most important. So now we know there are two things that make up the option pricing, and that's the intrinsic value and the extrinsic value. So let's go ahead and take a look at some examples. Here we have Tesla, and the current stock price when this screenshot was taken was around $250. So we're at $249.98. So basically $250. Now, if we take a look at the expiration on this, we can see that there are 0 days until expiration. So all of these contracts in this image are expiring on this day. Let's go ahead and look at the 245 call contracts. Now, if we look at the 245s, we can see that the price for these is $5.25. If you notice, 245 is $5 away from 250, which is at the money, which is where the current stock price is sitting. So $5 of this price here is based on intrinsic value. So if you own these option contracts at $245 strike and the stock itself is at $250, you have $5 of intrinsic value. Now you'll notice there's an additional 25 cents. That additional 25 cents is coming from the extrinsic value, or the little bit of time that's left in this contract and the little bit of volatility that it still has. But what you can see is on the day that this contract is going to expire, the majority of the option pricing is coming from intrinsic value, or how far away from the current stock price this option contract is sitting. Okay, so let's go a little bit further out in time just to see the difference in how these contracts are priced. So we're looking at the same stock, we're looking at Tesla. The current price is close to $250, so we'll just say it's at $250. And the contracts I have queued up here are 1 month out. So now let's look at the same strike price and see how it's changed. So if we go over here to the 245 calls and we look at the last sale on this, we're looking at $18.35. Now this is much higher than the $5.25 we were looking at previously. So the price in these contracts right now, $5 is still coming from intrinsic value. So we still have $5 difference between 245 and 250. But the other $13.35 is coming from extrinsic value. And that's because there are 4 weeks left in time in this contract. There's also volatility. And what you'll notice is some stocks have higher volatility than others, which will change the extrinsic value in the option contracts. Let's use Ford as an example to explain this. So here we have Ford. The last sale price of the stock was $12.42, so almost $12.50. And let's go ahead and take a look at the $9 strike price. So the $9 strike price on this is currently going for $3.56. You'll notice that $9 is about $3.56 away from the current stock price. We have mostly intrinsic value here with a little bit of an extrinsic value. Again, this is the day that the contract is actually expiring. So we can see over here that we have 0 days until expiration. Now let's flip it over so that we are 1 month out in time. So again, same expiration date as the Tesla example for the second one. And let's use the same strike price in this scenario. So again, the Ford stock price is currently sitting at close to $12.50. So this would be at the money. Now the contracts we're looking at are the $9 strike price. And if you notice over here, 4 weeks out is giving us an option contract of $5. So now we have $3.50 worth of intrinsic value, right? The distance between the strike price and where the current stock price is sitting. But then we have another $1.50 worth of something. This something is extrinsic value, so time and volatility. But notice how 4 weeks out in a Tesla contract was an additional $13 or so of extrinsic value. Whereas Ford, 4 weeks out, only has an additional value of $1.50. This is the extrinsic value of Ford. Yes, they both have the same amount of time, but the volatility is different between the two stocks. So this is where time and volatility get a little bit tricky in the extrinsic value area, but just know that those are the two factors that make up the majority of extrinsic value. So again, just to go over it really quickly, intrinsic value is the difference between the option contract strike and the actual price that the stock is currently sitting at. That's intrinsic value. The additional amount of the option pricing is extrinsic value, and that involves time and volatility. You should now have a better understanding of how option contracts are priced. You can use this knowledge to better understand how much a contract might be worth during the duration of the time you're holding on to it. This can help you better understand when it might be a good idea to exit or hold until expiration. As always, trade safe, thanks for watching, and be sure to keep an eye out for more videos like this.